So imagine taking out like a 25-year mortgage on this multi-million-dollar mansion.
Okay, I'm with you.
But you know for an absolute fact that the entire electrical system, like the very thing keeping the house functional, is going to completely fry itself in about 3 years.
Yeah, that sounds like a terrible deal.
Right. But you sign the papers anyway. You just know you're going to have to tear down the walls, rip out the wiring, and buy a brand new system over and over again just to keep the lights on.
Just burning cash.
Exactly. And that is essentially the financial reality that one of the world's largest tech companies has just willingly locked itself into.
It's honestly an unprecedented gamble. I mean,
Okay.
we're watching a company completely restructure its financial DNA in real time.
Absolutely. So welcome to the deep dive. We are thrilled to have you here with us. Our mission today is to examine a battle that is just tearing the financial world apart right now, which is the bull versus bear debate over Microsoft's fiscal year 2026 data.
It's a heavy one, for sure.
It really is. We're looking at a strategic pivot so aggressive and honestly so spectacularly expensive that it makes the original space race look like a rounding error.
Yeah, it really puts it into perspective.
Okay, let's unpack this because we are trying to figure out if we are witnessing the greatest technological land grab in history or, a highly dangerous spending spree that could actually cripple a titan.
Right. And what's fascinating here is that the conversation has completely shifted. I mean, we've spent years debating the theoretical potential of artificial intelligence, right?
Endlessly. The hype cycle was everywhere.
Exactly.
Yeah.
But this FY 2026 data, it strips away the hype entirely. The company has violently shifted from a speculative investment phase into a hard-nosed, show-me-the-money return phase.
Yeah, the rubber's hitting the road.
We're no longer talking about neat little chatbots or, theoretical productivity gains. We're talking about the astronomical physical cost of running the future of the internet.
Which is wild. And you really can't grasp why the bulls are popping champagne right now without staring directly at the cash engine driving this whole transition.
The cloud infrastructure.
Yeah, the undeniable explosion of cloud and AI revenue. That is the absolute foundation of the long position. Let's look at Azure. I mean, they just crossed the $100 billion annual revenue mark.
Which is just a staggering milestone on its own.
Right. Finding a B2B infrastructure business operating at that scale is nearly impossible today.
It is. But honestly, the sheer size isn't even the most compelling part of the Azure story.
Really?
Yeah. It's the velocity. You'd think at 100 billion, gravity takes over.
Right, like the law of large numbers. How can a $100 billion business keep accelerating?
Exactly. Growth should naturally slow down. Instead, quarterly growth for Azure just accelerated to 43%, and their forward guidance projects 45%.
That is insane. It's like they built a massive toll road with Azure, but they're also successfully renting out all the luxury cars, which is Copilot, that are driving on it.
That's a perfect way to look at it. They've essentially built an inescapable ecosystem. They are monetizing the underlying compute power, the data storage, and the software layer sitting right on top of it.
Yeah, speaking of that software layer, Copilot just hit 30 million paid enterprise seats. They literally doubled their net additions in a single quarter.
Wow.
And the developer version, GitHub Copilot, that's sitting at 50 million users.
It's massive. But, the metric that really solidifies the bull argument, the one that proves this isn't just a tech bubble mirage, is the revenue composition.
Okay, lay it on me.
Currently, 90% of Microsoft's cloud revenue is coming from non-frontier AI companies.
Oh, wow. And that destroys the biggest fear the market had last year. I mean, there was this persistent anxiety that all this cloud growth was basically just incestuous tech spending, right?
Circular money theory. Yeah.
Exactly. Like Microsoft selling compute to bleeding edge labs like OpenAI or Anthropic,
Yeah.
who are then just using Microsoft's own investment money to pay the server bill, like a snake eating its own tail.
Right. But if 90% of the revenue is non-frontier, it means adoption has officially gone mainstream.
We're talking real businesses.
Exactly. It's multinational banks, healthcare networks, logistics firms, major retailers. They aren't trying to build massive foundational AI models themselves.
Right. They're just renting the infrastructure to run localized AI tools across their daily operations.
Yes. The demand from everyday corporate America is so intense, it is actually outstripping Microsoft's physical ability to plug in servers.
Which is a great problem to have. But, finding companies willing to experiment today is one thing. The stock market and business strategy in general is about 2028 and beyond.
Very true.
If an airline tries out an AI customer service bot for 12 months and the ROI just isn't there, they just unplug it, A massive growth rate today doesn't guarantee a business tomorrow.
Which is precisely why the bulls point immediately to the commercial remaining performance obligation,
Yeah.
or the RPO.
Right, the backlog.
Exactly. This is the contracted future revenue. It's money customers have legally committed to spend, but that hasn't been recognized on the income statement yet because the service is still being delivered over time.
Here's where it gets really interesting. The commercial RPO surged 84% year over year.
Yep.
We are looking at a backlog of $678 billion.
It's almost hard to wrap your head around that number.
It is. That is equivalent to more than 2 full years of their total FY 2026 revenue completely locked in. To go back to the restaurant analogy, it's not just that they have a line around the block. It's that every single customer in that line has already prepaid for their dinners for the next 2 years.
If we connect this to the bigger picture, a backlog of that magnitude fundamentally alters the risk profile of the entire company.
How so?
Well, the weighted average duration of these contracts is 2.3 years, and 30% of that $678 billion will be recognized in just the next 12 months. It provides a level of revenue visibility that is almost unheard of in the tech sector.
Right, because startups don't sign 2.3-year, multi-billion-dollar enterprise infrastructure contracts.
No, they don't.
Only Fortune 500 companies with massive entrenched operations do that. They're structurally locking themselves into the ecosystem.
Exactly. Once you integrate your proprietary corporate data with Azure and you start building Copilot workflows across your entire workforce, ripping that out to go to a competitor isn't just a headache.
It's a logistical nightmare.
The switching costs are astronomically high. So that $678 billion isn't just a backlog, it's a defensive moat. It proves that enterprise AI isn't just a temporary sugar rush.
Right. Companies are embedding this technology into their core operational workflows. So the moat is deep, the engine is roaring, and the bulls are feeling invincible.
But serving a backlog of that size doesn't just happen by waving a magic software wand.
Nope. It requires concrete, steel, land, megawatts of electricity, and the most advanced silicon on Earth. And computing power is spectacularly expensive.
This is the central battleground of the entire debate. You really cannot understand the bare position until you look at the physical toll of the strategy.
Okay. Massive.
To deliver on those multi-year contracts, Microsoft has to build the underlying physical infrastructure. And the costs have completely decoupled from historical norms.
Let's look at the actual bill here. Capital expenditures skyrocketed to $41 billion in the fourth quarter alone.
Just wild.
Depending on which specific metric you track, that is a 70 to 110% jump year over year. And their guidance shows over $50 billion for the first quarter of FY 27.
Right. We are staring down the barrel of $175 billion to $260 billion in annual infrastructure spending going forward.
Every single dollar poured into concrete and servers is a dollar not returning to the balance sheet.
Exactly. And because of this staggering outlay, their free cash flow actually dropped 23%, down to $19.6 billion for the quarter.
Now, obviously, generating nearly $20 billion in quarterly cash flow is incredibly robust.
Sure, yeah. Most companies would kill for that.
But the trajectory is the concern,
There.
right?
Exactly. As the infrastructure bills compound over time, that cash flow margin is going to be under relentless pressure.
And this is where management deployed a highly controversial accounting adjustment to soften the blow.
Ah, yes. The depreciation schedule.
They officially extended the estimated useful life of their data centers and office buildings from 15 years up to 25 years.
It is a massive lever to pull because by depreciating those assets over 25 years instead of 15, you dramatically reduce the expense you have to recognize each quarter on the income statement.
It artificially props up your near-term operating margins.
Exactly. On paper, it looks much better.
But it completely defies the physical reality of the hardware. The data shows that 2/3 of this capex is going toward short-lived assets. We're talking about GPUs and CPUs, the actual engines of the AI revolution.
Right. They aren't lasting 25 years.
Not even close. These chips run 24/7 at temperatures that practically melt the motherboards. They have a realistic lifespan of maybe 3 to 5 years. And it gets worse because 7 to 15% of these chips literally burn out before they even hit the end of that 3-year cycle.
Yeah, you definitely can't amortize a burnt-out NVIDIA chip over 25 years.
Wait, so they are taking out a 25-year mortgage on data centers, but the actual engines inside them, The GPUs are burning out or becoming obsolete in 3 years. Isn't that like taking out a 30-year car loan?
Exactly. And the bears are laser focused on that exact discrepancy. The 25-year depreciation smooths things out for the accountants, sure, but the physical replacement cycle is going to be
It's
brutal.
a constant drain.
Yeah, there are massive recurring hidden costs here. You don't just build an AI data center and walk away for a decade. It's a furnace that requires constant feeding.
It's an endless, mandatory upgrade cycle. And if there's even a slight demand air pocket, like if that $678 billion backlog stalls or enterprise adoption slows down, those infrastructure costs are largely fixed.
Right. They don't magically shrink just because revenue slowed down.
Mm.
They are building a beast that has to be fed billions of dollars a quarter just to maintain baseline operations.
Oh, wow.
If the top line growth decelerates, the weight of those recurring hardware refreshes will absolutely crush their profit margins.
Which brings us to a really fascinating secondary effect of this strategy. Finding $50 billion a quarter in capital expenditures doesn't just happen in a vacuum.
No, it doesn't.
To feed this AI furnace, you inevitably have to starve something else. And the FY 2026 data shows us exactly who the forgotten child is right now, which is personal computing and consumer hardware.
The contrast in the segment data is genuinely jarring. While the enterprise cloud is going vertical, the more personal computing segment revenue actually declined by 4%.
Windows OEM and devices revenue dropped 7%. Now, sure, part of that is the end of the Windows 10 support lifecycle and some inventory hangovers, but the trend is undeniable.
And Xbox content and services fell 10%.
When I look at those numbers, I don't just see a bad quarter for gaming. I see a deliberate, ruthless strategy to bleed the consumer side dry to fund the enterprise side. Is this a sign of foundational weakness, or are they just ruthlessly pruning the bonsai tree? Are they letting Xbox and PCs wither because a dollar spent on AI yields 10 times the return of a dollar spent on a gaming console?
That is exactly the debate playing out right now. The bears view the consumer hardware decline as a glaring structural vulnerability.
Because they've always been everywhere.
Right. Microsoft has historically thrived on being ubiquitous, dominating your office desk and your living room television. Letting the consumer side hemorrhage while becoming hyper-reliant on B2B enterprise cloud services creates a lopsided, single point of failure business model. They are effectively abandoning the consumer mindshare.
But if I'm looking at this purely through the lens of capital efficiency, why on earth would I allocate a single dollar to an Xbox console that might scrape out a tiny single-digit margin when that same dollar spent on a server rack yields exponential returns in a highly scalable, recurring AI subscription?
And that is the bull retort. They view this as a masterclass in capital allocation.
Yeah, it makes sense from that angle.
Consumer hardware is notoriously cyclical, it's fiercely competitive, and it's low margin. AI enterprise software is incredibly sticky and wildly profitable. The bulls argue that management is intentionally rotating capital away from stagnant legacy sectors to sprint faster in the only race that actually matters right now.
They're shedding dead weight.
Exactly.
So what does this all mean? We have all the pieces on the board now. On one side, we have an astronomical $100 billion growth engine and a $678 billion backlog pulling in one direction.
The bull case.
Yep. And on the other side, we have terrifying capex bills that could reach $260 billion annually, dropping free cash flow, and a shrinking consumer market pulling in the other.
The bear case.
Exactly. When you look at how the market is actually pricing this massive tug of war, the valuation presents a really fascinating paradox.
It does. The valuation metrics perfectly reflect the deep division among analysts right now. The price-to-earnings ratios are hovering around 17.3x to 24x, depending on whether you are looking at forward or trailing metrics.
Which is remarkably low for a company of this dominance, right? I mean, their 5-year historical average PE is sitting up around 31x.
Right.
Even compared to direct cloud competitors, it looks like a steep discount. Amazon, AWS, and Google are both trading higher, generally in the 22x, 23x range.
And you really have to factor in the underlying financial quality, which remains undeniably pristine.
Yeah.
Yes, free cash flow dropped, but they are still generating roughly $80 billion annualized. It is. And they aren't just hoarding it either. In FY 2026, they returned over $43 billion to shareholders through dividends and stock buybacks.
Wow.
And their operating margins are holding remarkably steady, hovering between 45% and 58%, depending on the specific segment.
So as an observer, you really have to make a call here. Are you looking at a rare, historic discount on the world's most dominant AI platform? Or are you walking blindfolded into a value trap where these endless future infrastructure bills are just going to cannibalize all the profits?
This raises an important question about how we value modern tech monopolies during massive paradigm shifts. The bulls look at that 17.3x forward multiple and think it's the steal of the decade.
Because they've proven they can monetize it.
Exactly. They argue the company has proven definitively that it can translate heavy capex directly into immediate recognized revenue. For them, that $80 billion in cash flow proves the core software business is so wildly dominant that it can easily subsidize the physical build-out of the AI era without even breaking a sweat.
But the bears look at the exact same data set and see a massive warning light flashing red.
Precisely. The bears view the current valuation not as a discount but as a fair warning. They believe a massive growth premium is still built into the stock.
And if that growth stalls?
Well, if those 3-year hardware replacement cycles hit the balance sheet at the exact moment enterprise AI adoption plateaus, the margins will completely collapse. The bears are basically saying, yes, you have strong cash flow today, but you are locked into a profoundly expensive hardware cycle that you can never escape.
It really is a high wire act with no safety net. So to quickly recap the ground we've covered today for you guys, we started by exploring the sheer velocity of that $100 billion Azure cloud engine and the massive $678 billion backlog that proves real, sustained enterprise demand.
Which is a huge structural advantage.
Definitely. But then we weighed that against the terrifying reality of a $41 billion quarterly capex bill, the controversial 25-year depreciation accounting maneuver, and the strategic starvation of the personal computing and Xbox markets.
A lot of friction there.
Yeah, and all of it culminating in a surprisingly contested valuation that forces you to choose between the ultimate growth story and a potential margin-crushing value trap.
You know, we've spent this entire deep dive obsessing over the astronomical cost of building these AI data centers and this ruthless race for computing power.
Right.
But I want to leave you with a final concept to mull over on your own. Imagine we jump forward 5 or 10 years. This massive global infrastructure build-out is finally finished. The data centers are built, the supply chains are normalized.
Okay, picture painted.
If AI computing power becomes as abundant, commoditized, and cheap as electricity, does the company that spent hundreds of billions building the power plants still win? Or does the real profit pool shift entirely to whoever is inventing the appliances that plug into the wall?
Oh, wow. That is a brilliant question. When the dust finally settles on the greatest infrastructure build-out in human history, who actually captures the value? Well, thank you for joining us for this deep dive. Keep questioning the numbers, look past the headlines, and we'll catch you next time.